everybody. Welcome to today's fundamentals. Hello, Peter.
Hello.
What's up in the FX market?
Well, we had some rather mixed signals yesterday. It seems like the market has positioned itself and is expecting, or if you prefer, focusing now on today's interest rate decision by the Fed, which is expected to be the main market event.
And how about US stock markets?
US stock markets, we had some hesitancy on behalf of the bulls. It was characteristic that Dow Jones remained relatively unchanged, but S&P 500 and Nasdaq were on the rise. So that was a little bit more optimistic. I would be noting here that the release of earnings reports tends to get additional focus, given that we had yesterday in the aftermarket hours the earnings reports of Google and Microsoft. Now, both companies more or less tended to surpass market expectations both in regards to the EPS figure as well as the revenue figure. And I would be noting that tended to boost a little bit market confidence. There was one slight exception here. We had some comments about Microsoft's cloud business segment, which seems to be slowing its growth, and that tended to create some worries about Microsoft. So more or less, despite the artificial intelligence bet of the company starting to bear fruit, I would expect Microsoft share price to be a little bit under pressure. That wasn't the case yesterday, but we may see that being expressed by the market today. By the way, we continue to have our focus on the tech sector, and today we're highlighting the earnings reports of Meta platforms as well as eBay. I would expect that more or less we may see them surpassing market expectations once again, boosting the market confidence and providing some additional support for the shares. However, we have to note that both are to release the earnings reports in the aftermarket hours, so we may see a delayed effect here. But it's not only Meta. I would be noting that today we have other earnings releases as well. Say, for example, I would be noting Coca-Cola. We have also Boeing, AT&T. I would be noting also GlaxoSmithKline, and I wouldn't be surpassing the Europeans. We have from the Europeans Deutsche Bank, Airbus, and Banco Santander. So overall, we see that there is a high number of high-profile companies releasing the earnings reports, so that may more or less shift some market attention towards from the FX market to US stock markets and Europeans as well.
And what is in today's calendar?
Well, definitely the main event for the day is the Fed's interest rate decision. The bank is expected to remain on hold, to hike rates by 25 basis points and remain on hold afterwards. I would be noting that Fed funds futures implied probability of around 97% for such a scenario to materialize, and at the same time seem to show that the market marginally expects the bank to start cutting rates in around March next year. That would be around the end of Q1. So should the bank practically deliver a 25 basis points rate hike as expected, market attention is expected to be shifted towards the accompanying statement and the forward guidance included in it. We have to note here that despite market expectations for the Fed to remain on hold afterwards, there were some comments by Fed policymakers in the past month at which it was stated that we may see another rate hike after July. That's a big question in the sense that should the Fed in its accompanying statement and Jerome Powell's press conference later on show that it's still tilting towards the hawkish side substantially, allowing for the scenario of another rate hike, that may force the market to reposition itself and provide additional, maybe even asymmetric support for the US dollar. On the other hand, there is also the scenario that the Fed may not give up on its hawkishness just yet, but allow for its options to be open. In such a case, we may see the forward guidance including some mixed signals, which may allow the market to lower its reaction. On the other hand, the last scenario would be for the Fed to actually signal that it has reached the end of its rate hiking cycle, which would be justifying the market's expectations, may even intensify market expectations for a rate hike even sooner. And in that case, we may see the US dollar weakening. But the release as such is of a wider gravity and most probably will have ripple effects beyond the FX market. And I would expect a hawkish Fed to weigh on US stock markets as market worries for a possible over-tightening of the monetary policy of the Fed would be enhanced. At the same time, we have mentioned that a hawkish Fed could provide support for the US dollar, may also, though, provide a boost to US bond yields, which in turn could weaken gold price. So there are some mechanics in play here, which we should keep an eye out for. And other than that, in today's calendar, I would be noting, okay, we already had from France the consumer sentiment. I would be noting from the US the new home sales figure. It's for June, a drop is expected. Should that be the case, that could enhance our worries for the US construction sector and the real estate sector. And that may cause the USD to weaken somewhat. I would also be noting for loonie traders the release of BOC's monetary policy deliberations. That was before the July meeting and could provide some deeper insight regarding the bank's intentions and what the state of mind was of policymakers at the time of the release.
Great. Thank you, Peter, for your time and everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
So welcome to the technical analysis part of the presentation. My name is Peter Iosif, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame unless otherwise stated. Now, regarding the US dollar index, we note the stabilization of the index. It's very characteristic, just above the 100.80 support line. It's characteristic that the index in stabilization practically has broken the upward trend line guiding it. So we switch our bullish outlook initially in favor of a sideways movement bias, practically remaining just above the S1. But at the end of the day, we expect that future direction in the next 24 hours of the US dollar index is heavily dependent on the Fed's interest rate decision. Should the bank remain hawkish and provide some support for the USD, we may see the US dollar rising once again, breaking the R1 101.60 and start aiming for the 102.60. I would expect that should there be a bullish reaction, it would most probably be a strong one, especially should the Fed remain more clear-cut towards a more hawkish side. On the other hand, should the bank actually manage to weaken the US dollar in case, say, for example, that it recognizes that it's the end of its rate hiking cycle, or at least it's pretty near, then we may see the US dollar index dropping, breaking the 100.80 support line and start aiming for the 99.80. It's characteristic how the difference in expectations is. We're talking on the one side about 180 pips rise on the, 180 ticks rise, while on the flip side, we're talking about 100 ticks drop. For the time being, we tend to remain biased towards the sideways motion. I would be noting there is an indicator which is dropping and nearing the reading of 50. It hasn't actually just reached it, implying also a rather indecisive market. Let's have a look at Euro USD. Now, Euro USD has an interesting element. It's just about to break the downward trend line guiding it. You can see it shifting a little bit to the right. It's interesting that it shows a relative stabilization here. And that's over the past 24 hours, despite some gains during today's early European session. Sorry. I would expect the sideways motion to continue, and if that's the case, then we may see the pair breaking the downward trend line and remaining in the spectrum between the 1.1090 and the 1.1010. Mind you, once again, we are talking about the Fed's interest rate decision being critical to the pair's direction, given that the Euro USD seems to be more USD driven. Should the US dollar strengthen, then I would expect the pair to drop, break the S1 1.1010, and start aiming, if not even reach, the 1.0925. In case of a bullish scenario where practically the USD is going to be weakening substantially, we may see the pair rising, definitely breaking clearly the downward trend line guiding it, signaling the end of the downward motion, or an interruption at least, breaking the R1 1.1090, and start aiming for the 1.1185. Okay, let's have a look at cable. In the case of cable, things become clearer. On the one hand, we can see that cable was able to break above the downward trend line guiding it, breaking also the 1.2850, implying some bullish tendencies, very slight, very subtle, but there. It's characteristic that the RSI indicator was able to rise above the reading of 50, actually bounced on it and rose slightly higher. It's currently at 53.8, almost 54. So there are some slight bullish tendencies. Once again, though, we would expect that the Fed's interest rate decision is the key element or event which could be deciding the direction of the pair. For the time being, we definitely have to turn the 1.2850 into a support line, given that the price action has moved decisively higher. And let's go hunting for a new ultimate resistance line. Shouldn't be far too high than the R3. Okay, it's pretty far off, so allow me to, here we go. I would be noting this peak here. It was almost aimed for here, tested here, slightly lower. And that would be in red. The 1.3225. Sorry, my bad. Let's readjust the chart, correct the labels. Starting with the S3, which is now being placed at 1.2595. The S2 at 1.2730. The S1 at 1.2850. The R1 at 1.2995. The R2 at 1.3140. And the R2 at 1.3225. For the time being, we tend to maintain a bias for a bullish outlook, but once again, the Fed's interest rate decision is to decide that. So there is wide uncertainty. But definitely the fact that the pair was able to rise, breaking the downward trend line, guiding it, signaling exactly this interruption of the downward movement, but also was able to break clearly above the S1 1.2850, it used to be a resistance line, now turned to support, tends to imply some bullish tendencies. Also note how the price action has reached, and it's actually flirting with the upper Bollinger Band, while the Bollinger Bands have widened a little bit. All of that tends to imply some slight bullish tendencies. Should the pair maintain its bullish tendencies, we may see it breaking their 1.29895 and start aiming for higher grounds, however, at a slow pace. On the other hand, should the pair stabilize, I would expect a correction, but respect for the S1 1.2850 and the price action to continue moving in a sideways manner just above it. For a bearish outlook, I would require the pair to drop, break the S1 1.2850 and start actively aiming for the 1.2730. Moving now to USD/JPY. USD/JPY, which has moved decisively lower than the 141.35, so that has to be turned into a resistance line. And note how in the European session there was a wide drop of the pair. It's the early European session. It's something which we saw also in Euro USD, the weakening of the US dollar. And for the time being, we go hunting for a new ultimate support line. I would be noting this show here, once, twice tested, but also to the upside tested here. Seems to be quite valid. In green would be the 135.65. Let's reposition the labels as well. Starting with R3, which is now being placed lower at the 144.65. The R2 at 143. The R1 at 141.35. The S1 at 139.10. The S2 at 137.25. And the S3 at 135.65. Locking everything in. There seem to be some slight bearish tendencies here, and that's evident by practically two factors. The first is the fact that the price action has dropped rather substantially in today's early European session. And the second is the fact that the RSI indicator has dropped below the reading of 50 and remained below it. It's actually right now at 44.1. So there are some slight bearish tendencies here. On the other hand, please note that the price action has breached even slightly the lower Bollinger Band, which may slow down the bear somewhat. It's characteristic that the drop has broken also the 100 moving average in orange, but also the 50 moving average in green. But note how the 100 moving average has provided support once, twice, 3, 4 times before falling lower. It has broken all 2 of them. And that tends to imply some bearish tendencies once again. On the other hand, the Fed's interest rate decision is once again to be the key factor behind the pair's future direction in the next 24 hours. For the time being, we expect the bearish tendencies to be maintained and would not be surprised to see the 139.10 support line being broken. On the other hand, should the Fed actually provide substantial support for the US dollar, we may see the downward motion, the slight downward motion being reversed, the price action rising, breaking above the R141.35, and start aiming for the R243. Last but not least, a sideways motion is also possible given that the price action has tested and even breached below the Bollinger Bands, the lower Bollinger Band, which may force the price action to correct a little bit higher. Once again, though, higher than usual volatility is expected at the Fed's interest rate decision tonight. Let's move now to USD CHF. USD CHF, which, rose, yet hit the ceiling at the 0.8680 resistance line with a small exception here. Overall, though, there seems to be a sideways motion, some slight bearish tendencies, very, very typical. And I would even dare to say that they reflect the USD JPY somewhat. Should the US dollar maintain the bearish tendencies and the sell-off continue, we may see the pair dropping, breaking the 0.8590, start aiming for 0.8520. On the other hand, the RSI indicator is actually below the reading of 50. It bounced on the reading of 50, which tended to more or less highlight the slight bearish tendencies for the pair. On the flip side, despite that not being the main scenario for now, but it's still a possibility, should the USD get some substantial support, we may see the price action rising, breaking the R1 0.8680 and start aiming for 0.8755. Let's have a look at the Aussie. The Aussie seems to remain in a sideways motion, largely between the 0.6780 and the 0.6730. There seems to be no major movements here, despite the wide drop here during today's Asian session. I would expect the sideways motion to be maintained given the RSI indicator, despite dropping slightly, remains pretty close to a reading of 50. It's actually right now at 46.7. So I wouldn't be surprised to see it correcting a little bit lower, yet bouncing on the S1 0.6730 and correcting higher. On the other hand, definitely the Fed's interest rate decision is expected to increase volatility and could alter the current direction of the pair. In which case, should the bears take over, I would expect the pair to drop, break clearly this time, the S1 0.6730. Note how it was tested during today's Asian session. And start aiming for 0.6655. On the flip side, for bullish outlook, I would require a reversal of the past price action breaking the R1 0.6780. By the way, let's correct this a little bit. That's it. And start aiming for 0.6840. Okay, let's have a look at USD CAD also in sideways motion. Very typical. In this case, definitely we're going to be changing our resistance and support lines. This has to be moved and be placed as a resistance line. There you go. There are two going also a bit higher. Let's go hunting for a new ultimate support level. Unlocking the chart. Moving backwards to find a suitable trough or peak. Here it is. I'm going all the way down here to this trough here. It's very interesting. Note how it has reversed downward motion to a strong bullish upward motion. In green, the 1.2965. It's a little bit off, but the symmetry is not exactly what I'm looking for here. Let's replace the support and resistance lines. Okay, starting with the R3, which is now being placed at 1.3385. The R2, which is being placed at 1.3305. Let me adjust it slightly. The R1 readjusted, recalibrated practically at 1.3230. The S1 at 1.3135. The S2 at 1.3065. And please allow me to verify once again the S3 at 1.2965. So let's talk a little bit about the direction before we leave. The sideways motion seems to be maintained here. And with the upper boundary being the R1 1.3230, note how it was tested once, twice to the upside, but also to the downside and tested again here and here and here. It's a pretty valid level. I wouldn't be neglecting that. On the other hand, the downward boundary could be at the 1.3135. It was also tested a couple of times, briefly broken here. So that's the main boundaries of the pair's movement from now. On the other hand, once again, we may see the pair gaining substantial volatility at the Fed's interest rate decision. And should that be the case and the bulls take over, say in the case that the US dollar gets some substantial support, I wouldn't be surprised to see the price action rising, breaking the 1.3230 also breaking the 1.3305 and start aiming for the 1.3385. I know it's very high, but allow me to be a little bit more worried about USD CAD, given also the proximity of the US and the Canadian economy and the close ties. On the other hand, should the bears take over, we may see the price action dropping, breaking the S1 1.3135, breaking also the 1.3065, and start aiming for the 1.2965. Mind you that a possible bearish movement, in my opinion, would be of lower intensity than a possible bullish movement. I see more asymmetric risk to the upside rather than to the downside. Okay, that should sum it up from all of us here at IronFX. Best wishes for solid trading.
My name is Christina, and today we will talk about MACD. Moving Average Convergent Divergence was invented in 1979 by Gerard Apple. MACD is one of the most popular technical indicators in trading. Basically, MACD is a trend following momentum indicator that shows the relationship between two moving average of a security's price. The indicator calculates the difference between an instrument's 26-day and 12-day exponential moving averages, EMA. The 12-day EMA is faster than the 26-day EMA. Both moving averages use the closing prices of the specific period being measured. The MACD generates a bullish signal when it moves above its own 9-day EMA, and it sends a sell sign when it moves below its 9-day EMA. Using the MACD, traders can identify points in the price chart where the trend might be accelerating when the two lines cross. A lot of traders use this for an entry signal. Traders use the MACD to identify when bullish or bearish momentum is high in order to identify entry and exit points for trades. Thank you for watching.
Good afternoon. Hi, Atur. Hi, Owen. Just want to check that you guys can, before we get started, you can hear me okay? You can see me all right? let me know, put it into the chat. Sound and screen okay? Fantastic. Seems like everything's okay. We'll give it a couple of minutes before we get started. And while we're waiting, let me know where you're joining me from. And I hope you've had a good trading day, or trading week, or good start to the new year. And a happy new year to everyone as well. Hey Techno, how you doing? Hey Aya. We'll see who else streams in before we get started. Give it a couple of minutes. Today we're here with IronFX on the webinar series Mastering Divergence in Trading. Quite a number of things to get through today, so it'll be quite an interesting session. I hope you find it an interesting session and helpful as well. Hi there from Germany. Good to see you. Hey Esther, how are you doing? As we're going to be talking about divergence trading today, let me know if this is a strategy or method that you deploy onto your own trading as well. Do you use divergence? Do you trade with the divergence? I'm very well. I've had a couple of nice trades last night and also this afternoon, so I'm super happy with that. Hey Promise, how are you doing? Fantastic. Good to see. Does anyone attending the session use divergence in their trading? Why I'm asking is just so that I know, how fast or how slowly or how much detail to get into, customize the session a little bit more for you guys. And do let me know. Alrighty, let's get started. So again, welcome to everyone attending the session, and thank you all for attending the session. I know a couple of you have been waiting to join up, so thank you all for attending early and welcome to the session. Today we are here with IronFX on the webinar series Mastering Divergence in Trading, right? So before we get started, a quick disclaimer is that any information in this webinar should not be construed as investment advice or an investment recommendation, but instead as educational material only. This material is the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. What it means is that I will be sharing with you some ideas, some thoughts, the way to deploy divergence in your trading. What I do usually recommend is that whatever you learn here during this session, I would suggest that first you test it out, right? You read up a little bit more about it, you understand it a little bit better, then test it out on a demo account first, right? Never jump straight into a live trading account with a new strategy or a new method. What you're gonna do is test it out on a demo account. Make sure that you understand how it works. Make sure that you're able to identify the way it works on a demo account. Then you progress on to trade it, I would say, on a smaller trade, right? So size down when you go into a live account, size it down, test it out further. Once you gain that confidence with the method, then you can resume and possibly integrate it with your existing trading strategy. Okay, so these are all, I feel, complements to your trading strategy, not something that I think should overtake whatever you're currently doing. All right. So a quick introduction. My name is Jindao. Most of you will know me as Jin. I'm been trading for 10 to 15 years now already, so quite a long time. If you do have any trading related questions, please feel free to reach out, let me know. I'll be happy to address your questions as they come up. Okay, so today we're talking about divergence when we are in trading, right? Using different price levels and also the tools and indicators to help us to identify possible divergence. All right. Good to go. Any questions at this point? I do see that a couple of you are new to trading. So what I would suggest is that, this might be something that you want to look further into. It is a very powerful and quite commonly used method that a lot of traders monitor and deploy with their trading. So I think this might be a good starting point, right? And it's relatively simple to understand, relatively simple to analyze and to deploy. So it might be something that you might want to look into a little bit deeper as we progress through this session. So with that, let's get going. A couple of things to get through today. First off, obviously, what is divergence in trading? Right? What is divergence in trading? And as the word, let me just get that up. As the word suggests, divergence, right? Just plainly explained, in divergence means one thing is going towards upside, and then something else is going in opposite direction, right? Obviously, everything is moving towards the right, but one is moving higher, and then something else is moving lower. Or in the flip side, I should change the color. Let me just do that. All right. Or on the flip side, one goes down and then the two goes up. That's a terrible color. Sorry about that. Okay. So first off, what is divergence in trading? That's when we actually see price moving. So I always say that top level here is price. Price moving in a different direction to what the indicator is telling you. I can't scribble with the mouse, but what the indicator is telling you. So very commonly, most often, we always see, price moving in the up towards the upside, and then we see the indicator pointing towards the upside. So this is the common view, is that we see price pushing higher, while the indicator, for example, the RSI, is pushing towards the upside as well. So that's what we saw. We say a confluence, we would say it's moving in alignment, right? Indicator pointing in the same direction as price. When it comes to divergence, it's when price moves up, but we actually see the indicator pointing towards the downside or moving lower. What indicators can you use to identify a divergence? First off will be price at the top, but in terms of indicators, we can use the stochastic, right? We can use the stochastics, we can use the RSI, or we can even use the MACD, the moving average, convergence, and divergence. Quite commonly, the question I would get when I come to this point is that, people will be asking, so which is better? Should I, is the stochastic better than the RSI, or is the RSI better than the MACD, just based on the sequence that we're sharing? There is no better indicator to use. It all performs in a similar fashion, right? All performs in a similar fashion, but what it actually it should actually tell you a similar story, identifying that similar setup for you. So it really doesn't matter whether you use the stochastic, the RSI, or the MACD. Sorry about that. I'm still coughing terribly, so just bear with me there. Okay, so different indicators still would tell you a similar story. Then after that, on point 3 here, so this is 2, and this was 1. On point 3 here, we have different types of divergence. Different types of divergence. There are normal divergence, there are hidden divergence, and the exaggerated divergence. Now, put it into the chat. What do you think is going to give you a bigger possible potential move when you identify divergence? Normal, hidden, or exaggerated? What do you think is going to give you a bigger price movement? Normal, hidden, or exaggerated? Okay, right? Yes. So good stuff there, right? It exaggerated tends to give you, or would tend to give you a bit more of a potentially bigger price movement. But there are other things to consider, not just the types of divergence. And then with that, when we understand how to use the indicator, how to identify the different divergence, we'll combine them all together to look for our trade setups. Okay, so quite a number of things to get through today. At any point, if you do have questions, please feel free to put into the chat, let me know. And also, if time permits, what I'll do is at the end of the session, I'll jump into a live charts and try and identify some divergence or live occurring divergence for you guys. Sounds good? Alrighty. So first off, jumping ahead a little bit, the different types of divergence. Like I was telling you, okay? So I remember that on the top, splitting this, on the top is price, on the bottom is indicator. So there's the blue line and the red line. That's the regular divergence. The hidden divergence, again, price and indicator. And then the exaggerated divergence in terms of price and indicator. Okay, so how do you identify a divergence? Right, let's look at the regular divergence first. How do you identify a regular divergence? We split the divergence up into a bearish divergence or a bullish divergence. As the name describes, if we have a bearish divergence, what we anticipate is for price to drop strongly. If we have a bullish divergence, then we anticipate that price should climb higher. So things to pay attention to is the turning points on price, right? So we're looking for price to move up, turn back down, move up again, turn back down. So we have a higher high, and then another higher high. So we have higher highs. You say that that's the first part 1. Okay, this is what we have here. And then you look at the indicators, right? For example, in this case, let's say the RSI, and you're looking for it to form a lower low. So in this case, as the indicators might go down this way, bounce back up, turn back down, and then turn this way, you say this is a low and a lower low, right? So you say that we have a divergence, a bearish divergence, price forming higher highs, or the peaks of price forming higher highs, and the indicators forming lower lows. All right, so with that, we will anticipate that price would retrace or correct towards the downside. Remember, the things to remember here is that when you're looking at bearish divergence, you're almost somewhat identifying a upward trend line, right? Or a trend line that's resisting, providing that resistance to price, right? So it's hit the price resistance once, twice, and then a big retracement towards the downside. In terms of a bullish divergence, you're looking for a lower low in terms of price, a lower low in terms of price, and a, when price goes this way, no, let me do that again. All right, so when price goes this way and then this way, so now we have that trend line towards the downside, and then we have a lower, a higher low, right? A higher, this will be a lower high. Pardon me, this will be a lower high. Then we have that divergence towards the upside. So we call this a bullish divergence. Okay, so I'll take that away. I think the regular divergence is relatively straightforward in terms of identifying it, because we're looking for that higher highs and the lower highs in terms of the bearish, and the lower lows and the higher lows in terms of the bullish divergence. What happens with the hidden divergence? What happens if the hidden divergence is when you actually see price moving lower? So you have in this case, a high, and then we have a lower high, while we have the indicator actually giving us that, a high and then a higher high. All right, so it looks like it's pointing towards, it looks like those lines will be converging, pointing towards the same meeting point. That's what we'll have, the hidden divergence, a bearish hidden divergence. And then when we look at the bullish divergence, it actually separates out, it points further apart. You can see here, it's formed by a low and then a higher low, right? A low and then a higher low, while the indicator will be formed with a low and then a lower low, where you would have the divergence pointing in separate directions, one pointing towards the upside, one pointing towards the downside. That would say a bearish, or rather a bullish hidden divergence. And then lastly, the exaggerated divergence. That one is relatively straightforward to identify, because we're looking at price not forming that diagonal move, right? We're not looking at a higher high or lower high in what we had on the regular or the hidden divergence. What we're looking for in the exaggerated divergence, whether it's bullish or bearish, we're actually looking at price trading or forming a good, strong horizontal resistance or horizontal support level. Okay, so you can see here where we have here at this point, price testing, before testing again, horizontal level, right? A horizontal resistance, not looking for the higher highs or higher lows, and then, but the indicator forming a high and then a lower high, right? So you have price resisted to move towards the upside, but yet you have the indicator pointing towards the downside or trending lower. That's why we would say we have the exaggerated divergence on a bearish note. And then on a bullish note, we'll have it forming a support level, right? At a support level, while the indicator is forming a low and then a higher low, indicating further upside or indicating that bullish potential. All right. So quite a number of things to take note of in terms of identifying or understanding the different types of divergence. While this session is being recorded, what I will also suggest to you guys will be to, take a quick snapshot or do a quick scribble in terms of the the 6 different divergence: the bullish, the bearish divergence, for the regular, for the hidden, and also for the exaggerated divergence, right? So this, you can use it as a quick reference guide. Okay, so if you have already, great. If not, let me know. I'll come back to this slide again. So looking at it in terms of on a chart, it's fine. It's relatively easy to identify it when we're looking at it with lines purposely drawn to identify the divergence. But how does it look like on a chart? We have the examples here. You can see that firstly, price is testing a resistance level, right? It's formed. It's almost, if I can draw a horizontal line, you can see it's formed right across, right? Forming a little bit of a smaller high, resulting in a bearish divergence with RSI. So it's tested a bit across, but you can see that in this case, it's moved up a little bit, right? So we're talking about small movements. It can also sometimes be quite obvious, right? Sometimes it's quite hard to identify a divergence or bearish or bullish divergence, but sometimes it's going to be quite obvious. In this case, as a first example, almost horizontal, almost like an exaggerated divergence, but we also would say that it's a bearish divergence here. And then you can see RSI first at this point, and then trending lower, right? So this is a little bit more obvious. You can see it pointing towards the downside. So we either have it going up like that slightly, potentially, and then after that, the RSI forming that. Oops, I'll draw that better. And then the RSI forming that move lower again, right? So we're looking at that. And then if I scroll back, you can see that for this to point up and this to point, the indicators trend to point down, right? Pointing up and pointing down, or moving right across and pointing down. So this would tick the examples of either a regular divergence or the exaggerated divergence, which still would give us the indication that we're looking at a potential bearish move towards the downside. Okay, so you can see here, price moving across, right across, or slightly towards the upside, and then the RSI here moving slightly lower, right? So we see that divergence, that bearish divergence. And what happens? You see that price traded strongly lower, right? Strongly lower, not just because of the divergence, right? Price reverses strongly from that horizontal resistance level. It also traded lower because the RSI traded down, right? From the overbought region to the almost towards the oversold region. And also because of that bearish divergence. So what I'd like to do, right, as much as we're talking about the divergence here, right, as much as we're talking about the divergence here, I wouldn't recommend, entering a trade just because of a divergence. I wouldn't do it just because of a divergence, right? I'll still be looking at, yes, I'll identify a divergence, but before that, I'm looking at support and resistance levels, right? You can see price resisting that resistance level. You could also be looking at the previous trend. And also you'll be looking at indicators just giving you that signal of where price could be heading towards. Putting all that together, then after that, identifying a divergence gives you that confidence, right? Gives you that confidence because you get a confluence of analysis. You get many things put together, giving you the same signal telling you that we're potentially looking at some downside, and that's why we see price having moved strongly lower. All right, at this point, any questions? Any questions at this point? Let me know. Or if it's all good, clear and good, let me know as well. And we'll move on. Alrighty. Okay, so with that, thank you, Esther. With that, we look at again another one, right? An idea of a repeated divergence. So now let me ask you, if you see a divergence and it trades well, and what happens? What do you think will happen if you see multiple divergence? If you see it happening over several times, most likely going to give you a stronger signal, right? A repeat of what could happen. So in this case, quite straightforward. You can see that price pushing higher, right? Moving towards upside there. Oops, I'm terrible with this drawing. Right, you can see price forming a higher high. You can see price having a high there and then forming a higher high. But yet we see the stochastics. In this case, in this example, we're looking at stochastics forming a lower high, right? So this was the high point here, and then it's formed a lower high. So it's pushing towards the downside. Again, as price pushes up and the indicator, in this case, the stochastic pushes down, what we would have is a bearish divergence. And you'll see that, if I can just draw a straight line across, that was the previous resistance level, right? We saw a little bit of a break towards the upside. And then because of that bearish divergence, we saw price come strongly towards the downside. Okay, so this is also one good way or another tool to help you identify potentially some false breakouts. I always get questions from individuals that I coach in terms of how do you identify a potential false breakout. You know, you could use divergence as price breaks out of a resistance level. You see a divergence form, you anticipate that price could trade back down again. In this case, you can see as the divergence forms, we see price trade lower. All right. So what is a repeated divergence? You see again, if I take that away. Okay, if I take that away, you'd see that now we have that high and that forming slightly lower. Again, a slightly lower high on the stochastics. Right? No, they're here. Okay, high there. One formed, and then after that, this formed here. But yet, price is moving towards the upside. Again, another bearish divergence. I was just sharing with you before, just as I was drawing that, why this wouldn't work is because as much as we see this moving a little bit across, a little bit towards the downside, we haven't seen price, or price rather has been trading right across. It hasn't really turned towards the upside. We haven't seen a higher high, right? Or we haven't seen it turn down from that resistance level. So it hasn't really formed a divergence yet from this picture, right? So we have one divergence formed here. And then as price goes up, you'd say that there's another divergence as we see this push higher while the stochastic pushes towards the downside. Okay. And what's very interesting here at this point is also to identify that this is a bit of a resistance level formed on the stochastics, right? It's also a resistance formed on the stochastic where you see that it's hit that level here and turn back down, again hit that level and turn back down, which could be also considered as a hidden resistance level. Why is it hidden? Because we normally draw the resistance level on the price charts, not on the indicator chart. All right. So with this repeated pattern at this point, Well, what could you anticipate? We'd say that we anticipate for price to turn down because of that bearish divergence. And that's where you see price shooting towards the downside as that bearish divergence forms, as it retraces or breaks out from that upward move. Okay, so we've gone through just a couple of divergence at this point. Firstly, the normal divergence, right? Just a quick introduction of the normal divergence, and then also the repeated divergence where you see it happening once and a relatively small move towards the downside. But then after that, when you see it happen twice, a repeated pattern, you see a bigger move tracking lower, right? A bigger move towards the downside on the bearish divergence, because it's already happened once, small move, and it happened again, we see that big move down. Okay. So with the divergence, as we were looking at it, you have that high, that higher high. So this was a high point. This is a higher high. And then also when you have the stochastics or the RSI or the MACD giving you that lower high. I'm just trying to draw it properly. High point and then that lower high point, right? So when you have that pointing down and then that pointing towards the upside, we can pretty much identify where is an entry point. Where's an entry point is when the turning points align, right? I didn't draw it exactly. I was trying to struggle to draw it a bit, but when the turning points align. So in this case, you can see at that dotted line, I would say as the candle closes, just to ensure that you see that downward move or that pivot level, you'd say that that would be your entry level, right? Your entry level. Then the common question comes is, wait, so if I know that at this point, that's my entry to sell, right? The entry to, let me just do that again. It's terrible to try to write with a mouse. Right? That's where you would be looking to sell. Then what happens is the next question comes with, okay, great, Jin. If I'm looking to sell at this point, where's my take profit going to be? All right, where's my take profit going to be? This case here, where the divergence started. It could very well go a lot lower than that point, but you'd say that your first target could be at your take profit would be here. That'd be your first take profit level. You might be looking to close out half the trade at that point, right? What I would suggest is you could be looking at closing out half the trade, right? Or you could be looking at moving your stop loss to break even when price comes to that point. Or, well, you could be looking at closing out the trade completely with your take profit. Okay, so you say that if I'm looking to sell at the formation of that divergence, my first decision point will be at the take profit level where the divergence started. My stop loss, I would say, would be above that previous high as your stop loss level. Okay, so relatively tight. You tend to have relatively tight stop loss when you're looking at divergence, when you're looking to trade divergence. That's why I suggested at the start that this might be quite a good starting point for a lot of new traders, right? You have a relatively tight stop loss, and then your take profit. If you're not so risk seeking, you could be looking to close out exactly where it started, or you could be looking to close out half the trade or any amount of trade, or you could be looking to move your stop loss down to the break even level just to protect the trade and see how far down it can go. Okay. So in this case, you see that as we spotted that divergence, right? We were looking to sell at this point here. Our stop loss would be above, either above that previous high or above that divergence. I would say at about that point. And then your take profit would be at this level here. Okay, you see it come down, come close, bounce back up, and then after that, complete that reversal to hit your take profit level where it first started, where that first divergence started. Okay, in fact, here's another divergence that you could have entered on the shorter term. All right, and we say this would be the exaggerated version of a divergence. You can see that price moving right across. Right, so a horizontal movement or horizontal resistance on price, and yet we also at that point see the RSI in this case forming a high and then a lower high. So with that, if I can draw a straight line down, almost did it. Right, as that forms, you see that price shot towards the downside with that divergence forming as well. Right, so it's not just that big move that you have identified. You can identify other potential divergence within one move. Right, so you could have one trade. I would say this would be your first trade, and then as price comes down, bounces back up, you form another divergence, and then this would be your second trade towards the downside. This would be number 2. Okay, so in one move, over a medium long period of time, you could have multiple divergence being formed. I didn't see that question there. I didn't see anyone raise that question. When, so commonly what the question I'll get is when, in terms of time frame, can you use or can you look to identify a divergence? So this can be done, or divergence can be identified on any time frame. Okay, you could be looking at it on the daily time frame. Oops, not the P, it's a D. Right, so you could be looking at it on a daily time frame. You can looking at it on the H4. You could be looking at it on the H1 even. Right, but as much as it'll work across everything, I would say is that M15 might be the lowest that you go down towards. Right, I wouldn't actually look at anything lower than that, because what happens is that anything lower than H1 tends to get a little bit noisy. You see price fluctuating around with quite significant or choppy price movements. So if you try and identify it on too small a time frame, what you might actually get is possibly a lot of divergence in terms of occurrence of a divergence, but it might not all play out very well. Okay, so I would say that if you really have to, or if you should, keep it to the daily, the H4 or the H1 time frame. And if you really, really have to, with nothing else to do, then you might consider the M15 at the very lowest. I wouldn't trade it any lower than that, any lower time frame than that. Fair enough? Good stuff. Okay, so with that, right, we'll be looking at forecasting. Right, forecasting, we put it all together. We try and identify where price could be heading or has been heading, and then how it could turn with a divergence. In this case, you see that the RSI broke the trend line or broke the supporting line before price did. Right, you see that moved down, but yet you identify this. Okay, you identify a lower high, and then here forming in this case, a higher high, right? A higher high. So straight away, we can see that a bearish divergence is formed. In this case, using the RSI, a bearish divergence is formed. Price broke the RSI broke the ascending support, indicating that price might trade significantly lower. Then after that, we look into price breaking out the ascending support line, right? Showing again, similar to what we identified on the bearish divergence, because at that point we're anticipating for price to move lower, we're looking for that big downward move. Okay, so you're actually combining a few analysis together. Not just, remember, it's not just the divergence. You're looking at trend. You're looking at support, resistance. You're looking at the indicator itself. All that add together with the divergence. Sorry for the scribble. What it ends up with is we're going to see a higher probability trade setup for potentially big move towards the downside, right? And you see that big push as it not only has a divergence, but it breaks the trend line as well. Fair enough? All good so far? Okay. Similar thing here. You see that price has been resisted by that trend line, right? Price has been resisted by that trend line as it trades lower, right? As it trades lower, first thing, how do you like get ready or get preempted to look for potential divergence is when you see the indicator giving you that early signal, right? You see that trend line towards the downside again on the RSI here, and then the indicator, and it gets resisted here, looks to break out of that trend line, of that downward trend line. With that, you'll be going, okay, great. It's looking like, or the indicator is indicating the potential for some upside. From there, you'll be looking at, can I identify any potential divergence? So in this case, you see price forming a lower low, right? Price forming a lower low, but the indicator forming a higher low. So what happens when you have a lower low in terms of price and a higher low in terms of the indicator? We're going to have a bullish divergence, right? It forms up with a bullish divergence. And as the RSI breaks above that trend line, we're going to see that potential for the upward move. Even as that divergence is formed, let me just do that straight line again to the best I can. Right, even as that divergence is formed, we already see price moving higher. So that's your first move. Sometimes you will not be able to catch that move straight away. You might not be looking at the charts during that time. You will see a divergence or bullish divergence formed. You might have missed that first move, but as price looks to break out of that trend line, break above that trend line, you can also see that if it breaks above that trend line, I have a bullish divergence supporting this analysis for that potential move or big move towards the upside. And then you can see that as it breaks out, we see not a steep move, but we can see price trading higher along with that bullish divergence and that trend line. Okay, so this is another way to add on, all right, add on to not just a plain divergence. You'll also be looking at adding the trend line to it just to help you identify a potentially bigger move as well. Okay, so sometimes as I teach a lot of traders how to use a divergence, they might not spot it right at that point because you're not watching the charts. But if you identify a divergence after it's happened, you could also be looking for additional information as it breaks above a trend line or a resistance level. You're going to see a potentially bigger move towards the upside or the downside. Any questions so far? All right, we've come to the end of the slides. So I just want to check if you've got any questions so far. Just let me know. I'll give you a couple moments to check, to type it up if you've got any questions. Okay. This is recorded. I think you can possibly head to the YouTube channel. I'm pretty sure it will be uploaded there. If not, you can probably reach out to one of the guys at fantastic guys at IronFX. I'm sure they will be able to get you a version or recording of this session. All right. Oops, let me move that away. Okay, so like we were talking about, okay, so we're going to try and identify a couple of potentially divergence levels. Okay, so what you're going to look for in terms of a bearish or bullish divergence. Let's look for a bearish divergence. This is on the, let's do on the H4 time frame. The hidden divergence is just when you have price. Let me just try and draw that out. Okay, so a bearish divergence is when it points, price does that. Okay, and then the indicator points this way. Okay, so you have a not the best drawn, but a lower high, lower high, and then you have a higher high on the price. For a hidden divergence is when it points in this direction. When price has a lower high, but yet the indicator is forming a higher high. Okay, so you're comparing these two together. Right, so it's just pointing in different directions. Both of them are bearish divergence. Both of these are bearish divergence, but you just have price pointing in a different direction compared to the indicator. Does that answer your question there, Promise? Fantastic. Good stuff. Okay, so let me try and do this. Let's see if we can identify a couple of divergence. Tricky to do it on the spot straight away, so just bear with me for now. We could actually be looking at no, that doesn't form. Okay, so things to watch out for when you're trying to do a divergence. You can see that price in this case trading, forming a lower high, right? Forming a lower high in this case. And then after that, so you would think that maybe I have a hidden divergence here, but you say that on the RSI, this is also forming a lower high. So it doesn't work in this case. You don't want to try and force the analysis. We do have, nope, not here. Might have something here. A lower high formed, and then not the best. It does get tricky when you try and find something on the spot. Okay, let me just try and find another different chart, something that moves a little bit more stagely. Just wanted to make sure that I try and give you guys an example. All right, do we have something here? Okay. So we have price forming a higher high. Okay, so this is how we're looking at it. Price forming a higher high. And then after that, the indicator forming a, oh, don't have it there. It's supposed to turn to be down this way, so it didn't form. Well, I was hoping to identify that. Okay, let's try this one. Price forming a downward move, and that's pointing towards the downside as well. I just want to find something. this way. Nope. It's all following in the same direction. Showing the H1 time frame. We might have something here. Okay. So in this case, we have price forming a higher high, while we have the RSI forming a lower high. Okay, you can see that price forming a higher high where we see it going this way, while we have the indicator forming a lower high where price goes down this way. All right, so that is what we call a bearish divergence, a regular bearish divergence, and that's why we can actually see that as the price as the divergence forms, right? Even slightly before that, as divergence forms, we can see price trading significantly lower. And even this case, you can even say that it's formed right across, but I think that it's more accurate when you say it's at that point. All right, I'm glad I found at least one example for you guys. Let's see if we can find another one. So a higher high here, higher high here in terms of price on the, and then after that, the indicator forming a lower high. Okay, so there you have it. Another example here. Oops, as price forms a higher high and the indicator forming a lower high. Again, another bearish divergence formed on the US yen on H1 time frame. All right, does that make sense? It's hard to try and find it, so I wouldn't suggest trying to sit there and look for the divergence specifically, right? I would say that how I deploy or how I use the divergence is that when I identify a trade and then I somewhat identify a divergence, it supports the analysis that I was doing. It supports my view that, on my previous view and my previous strategy as well. Okay, so don't go sitting there trying to spot only divergence. It's going to be a rather futile effort. I would say that it'd be better to try and look for that moves instead. Okay, so we can also see here price pretty much trading right across, right? Price trading right across, but yet in that same period, we actually see the indicator pointing, or the RSI pointing towards upside. What we have here is the exaggerated bullish divergence. You see that at that point, right, as that's formed, price pushing strongly upwards. Okay, exaggerated bullish divergence is when you see price testing the same level right across, while the indicator forms a lower or higher low. All right, does that make sense to you all? As we come to the end of the session, I hope you found the information useful and interesting and useful. Thank you, promise. And if you do deploy this onto your trading strategy, please make sure you test it out first, build that understanding, build that confidence level, first on a demo account, then on a couple of small trades before you start trading, and complementing it together with your own trading strategy. With that said, I wish you all good trading ahead. Remember, trade well, trade safe, and I'll catch you again. Take care now. Bye-bye.